Hello everyone, and welcome back to Explain the Charts. Today is October 5th, 2025, and we are diving deep into USDJPY, which is sitting at a fascinating crossroads. The big story right now is the major policy divergence between the US Federal Reserve and the Bank of Japan. Recent news suggests the Fed is on track for more rate cuts by the end of the year, driven by softer US labor data and concerns over a potential government shutdown. This has been putting significant pressure on the US dollar. Meanwhile, in Japan, we have a different picture. Despite a recent rise in the unemployment rate, core inflation remains stubbornly above the Bank of Japan's 2% target. BoJ Governor Ueda has even reiterated the central bank's readiness to raise interest rates if conditions permit. This fundamental conflict is compressing the US-Japan bond yield spread, which erodes the dollar's carry trade appeal and provides a strong tailwind for the yen. We've also seen speculators unwinding their short JPY positions, signaling that the market is growing cautious of further USD strength. Now, let's see how this dramatic fundamental backdrop is reflected in the price action on our charts. Looking at the daily chart, we can see the broader story of 2025 unfold. After peaking above 161 back in July, the pair entered a significant downtrend, finding a bottom near the 141.60 level in early August. From there, we saw a strong recovery rally through August and most of September, with the price climbing back towards the key 150.00 handle. However, as the news has highlighted, this is where the rally slammed into a wall of resistance. The market failed to sustain a break above 149.80, a level reinforced by potential exporter hedging and verbal interventions from the Ministry of Finance. This rejection was sharp and decisive, initiating the recent leg down that we're currently analyzing. This move perfectly correlates with the recent shift in market sentiment towards a weaker dollar and a stronger yen. Let's zoom in on the price action from the beginning of September to get a clearer view of this reversal. Here you can see the peak on September 25th, where the price hit 149.95 before being aggressively sold off. In just a few trading days, the pair plummeted, culminating in the low of 146.58 we saw on October 1st. This drop represents that 1.1% weekly decline mentioned in the headlines, a very significant move for a major currency pair. Crucially, the bounce we've seen over the last 2 days originated from this 146.55 to 146.60 area. Many reports identified this zone as a key support level, possibly aligned with a 100-day moving average, and so far, it has held firm. The price has since recovered to just above 147.40, but it appears to be consolidating, suggesting the market is uncertain about the next move. Now, let's switch to the 15-minute chart to dissect this recent bounce and consolidation. Here we can see the sharp reversal from the lows on October 1st. The initial climb was quite strong, but since then, the price action has become choppier. We are seeing a series of higher lows, which is constructive for the bulls in the very short term. However, the upward momentum has clearly slowed down as we approach the 147.50 level. This indicates that while buyers stepped in at the 146.60 support, they are now meeting some selling pressure. The pair is essentially in a tight range, coiling as it awaits its next major catalyst, which will likely be the upcoming U.S. non-farm payrolls report. Returning to our daily chart, let's map out the potential scenarios moving forward. The bearish case is compelling and seems to have the fundamental winds at its back. If upcoming U.S. economic data continues to be soft, it will cement expectations for Fed rate cuts. In this scenario, a break of the critical 146.55 support level would be the key trigger. A daily close below this pivot would open the door for a swift move down to the major psychological level of 145.00, a target cited by multiple analysts. On the other hand, the bullish case hinges on this support at 146.55 holding strong. For bulls to regain control, we would need to see a decisive break above the immediate resistance around 148.00. The next major hurdle, according to reports, is the 200-day moving average, said to be around 148.35. A break above that level could trigger a significant short covering rally, pushing the price back towards the 149.00 and even 150.00 resistance zones. This would almost certainly require a surprisingly strong U.S. jobs report to change the narrative around the Fed. So, to summarize everything, let's recap the most important levels to watch. Key resistance is at 148.00, followed by the more significant 148.35 and the major psychological ceiling at 150.00. On the downside, we have immediate support around 147.00, but the make or break level is the recent low between 146.60 and 146.55. Below that, the next major target is 145.00. Given the current fundamental momentum, a bearish continuation seems most likely, and I'd place about a 60% probability on a retest and eventual break of the 146.55 support, especially if U.S. data comes in weak. A bullish reversal, requiring a break above 148.35, seems less likely, perhaps a 30% chance, and would need a strong fundamental catalyst to fuel it. There is also a 10% chance we remain range-bound as markets await more clarity. Keep a close eye on the upcoming non-farm payrolls data and any statements from Fed or BoJ officials. Thank you for watching this analysis on Explain the Charts. Please remember, this is not financial advice and is for educational purposes only. Always conduct your own research and analysis before making any investment decisions.